Hello, everyone. My name is Mark Jacobson. Thank you very much for joining me on my webinar today. Just a couple of quick things. So first of all, I'm not trying to sell you anything here today. This is designed to be an informational webinar. And if you like what I talk about, you can certainly set some time to come and talk to me about it. We are going to be talking about some products today, but those products are as they exist today. It could change in the future. So just be aware of that. Also, we sincerely ask that you not video or audio tape the webinar. It's all copyrighted information. We're giving you the opportunity to get a gift card today as well. In order to get the gift card, you're going to have to do a couple of things for me. First of all, we've got 4 different poll questions. So we're going to ask you those questions. You need to answer them. Also, there's a brief survey at the end you'll need to complete, as well as you'll need to accept a phone call from my assistant, Pat Marquette. So as long as you do those things, we'll be glad to send you the gift card. I want to tell you a little bit about me before we get any further today. So I've been in the insurance industry for over 37 years. I've been married to my wife, Denise, for over 26 years now. We have 2 sons, James and John, and I have an older son, Alex, who lives in Florida. Now, the one thing I'm almost as proud of as my family is my track record in my industry. Doing this for a long time, and I want you to check me out. So there's some good ways to do it on this page here. So you've got different links to the states of Massachusetts, New Hampshire, and Maine departments of insurance. I'm licensed as an individual and a corporation. And if you would like us to send you these links, we'd be happy to do that. The Better Business Bureau have their highest rating, and the National Ethics Association, I have their highest rating as well. So do check me out. You can Google me. You won't find anything bad. I'm very proud of my record. We've got different office locations, so we strive to have our clients not have to drive more than 20, 30 minutes to come see us. So our main location is in Portsmouth, New Hampshire on Islington Street. And then we've also got offices in Methuen, Mass., Bedford, New Hampshire, Nashua, New Hampshire, Woburn, Mass., and Beverly, Mass. So you can see me in any of those different locations, whatever is most convenient for you. So if you're ready to start here, I certainly am. Let's talk a little bit about where your money is today. And this is something that is very dear to me because I find that most people don't really understand their money. They don't know what their fees are. They don't know what makes it go up or down. They don't understand what they've really averaged on that money. So the most logical, or certainly the first place that you may have learned about making money in life, it might be the bank. That's a place that we like because our money's safe there, right? We're not getting quite the returns that we want, although they've come back recently. But you have to be concerned today about some of the things we've seen in the news with larger bank failures. And that has to do with, of course, the economy completely changing after COVID and not really being able to expect norms that we used to rely upon in the past. And banks can be problematic when interest rates go up because they might have bought instruments to make money on your money years ago that were paying much lower. They loan money out. So, how banks make money is through short term instruments and then by loaning money to different businesses. And if those businesses fail, that can be a real problem for the bank. So we know that you've got insurance on up to $250,000 of that money. People like that with their money in the bank. So you just don't want to have too much money in the bank. Now, the second place that you might think about is, of course, the stock market, where we know that the market goes up and down. You've got risk and you've got fees, and you never really seem to know what you've made on your money. You're looking at your statement from a recent period. It shows that you're up, but then you remember that you lost 20% last year. So you have to factor that in. You have to back out the fees, not only what you might be paying an advisor to help you with that account, but any particular mutual fund or transactional type of fees that exist with a lot of advisory accounts. So it's really incumbent upon you to understand how that money is really done over time. And that's not always easy to do. We do have some really good tools that we can go over with you in an in-person meeting where you can determine exactly what it is that you've made on that money. We call that real rate of return, compound annual growth rate, what you've really made on your money. So, a real question to ask here is it fair to pay fees when the market has failed you? So, if you have an account with an advisor, could be a national firm or maybe your local bank or someone who's a registered investment advisor, an independent person, and you lost money, you still had to pay those fees. Is that fair to do? Now, one thing I want to do with you right now is go over what the market has done over the past 23 years or so. So this chart's going to look familiar to a lot of people because it's the S&P 500. It's the nation's best 500 companies. And we're going to take a look and see how the S&P 500 would have fared. So let's say going back to 1999 when this chart starts, you've got $100,000 going into the market. Now that first year you made some decent money, you're up almost 12%. That's pretty good. And you might have even thought, well, I should really take that gain out and put it somewhere safe because then it's a real gain. But there probably wasn't a lot of people close to you or advising you about that account that suggested you take it out because they're going to tell you things like over time the market beats everything, you're in it for the long haul, when you lose money it's only a paper loss. All of those different cliches you're going to hear, so you leave the money in there. And of course, 20 years ago we had the dot-com bust where all of that growth from the 90s was wiped out in just a couple of years when the market started its decline and eventual recession, followed by 9/11, which further increased the duration of that recession. So over that 2-year period, not only did you lose the $12,000 that you made in the market, you've also lost a significant portion of your initial investment. Now the market comes back, and this next boom in the market was the housing boom. So people were actually borrowing money on their houses to invest in the market, which wasn't always the wisest thing to do because we know that eventually the market's going to crash again, and it certainly did that. So it peaked at the end of 2007, but then it starts another decline. And this decline was more unique from the dot-com bust in that it was almost overnight. So with the Great Recession, we saw losses of up to 50% seemingly overnight. So it was a very dramatic recession, and it too took 2 years to finally hit its bottom. Now, when the market starts coming back, you might be thinking to yourself, wow, well, that looks pretty good. There's a pretty sharp increase there. What was it that caused that increase? Well, that was really due to low interest rates. So, through federal monetary policy, keeping interest rates artificially low, it certainly encouraged the market to grow. So there was nothing truly bona fide here of economic prosperity or growth. It was simply the fact that it was cheap and easy to borrow money, and Wall Street likes that. So the market it really responded extraordinarily well, and it peaked in September of 2021. Now, something, of course, happened in 2020 that you may remember, and that's the pandemic, where all of a sudden the world was topsy turvy. And we went through a period of 2 years where we weren't making anything. And then, of course, when we came out of the pandemic or slowly started to, people wanted to spend money, yet there wasn't enough goods and services for people to spend on. So that really was what caused inflation. And the cure for inflation is, of course, to raise interest rates. And you may argue that the Fed waited too long to do that, which likely they did. But anyway, it took a while for the market to start to respond to those higher interest rates. So we've been in this inflationary spiral now for a couple of years, and Wall Street does not like inflation. So when things cost more, people spend less, and you're likely to see a market in downturn, which is what we saw certainly. So the S&P 500 has not really grown in 2 years. It's at the same level it was 2 years ago. So that can be problematic for people wanting to make money in the market. And it really kind of depends on the time period you're measuring. Now, sometimes people will say to me, but Mark, the S&P has averaged 9% over its 100-year history or whatever it is. That may be true, but the question I have is, do you have 100 years? You don't, obviously. So you need to look at the S&P in different increments. So the last 2 years hasn't made anything at all. The last 5 years, it's maybe 4, 5, 6%. In the 10 years, it's done about 10%. Now, from 2000 to 2010, it was negative 18%. Overall, on my chart here, S&P 500 has averaged about 5.5, 6%, depending on the day of the week, what it's done that day. So you really need to understand that because of the ups and downs of the market, you need to be concerned about not losing anymore because you don't have what on your side? Well, you don't have time on your side. So everybody on this webinar today is likely at a point where they're either in retirement or nearing retirement. You can't afford to lose money in terms of acquiring or attaining your retirement goals, staying retired, retiring on the timeline that you want. So I have my first poll question for you today, and that is, if the market were to go down 20%, if you were to lose 20% of your money, what percentage would you have to earn to make back that 20%? Now you'll see your poll question. It's a 3-bar icon. You'll either see it to the right of your screen or at the top. And again, the question is, you lose 20%, what do you have to make? What percentage to make back that 20%? If you'll take a moment to answer that for me, that would be great. So the answer to that poll question is 25%. If you were to lose 20% due to market loss, you would now have to earn a 25% gain to get back just to where you were. So my point is that it's harder to do. So you might not have the time to get back to that level. I think it's important when you assess your money choices that your money is good for you today, tomorrow, and if you were retired or if you were to die. So when you look at where your money is, you have to answer that question in those terms: today, tomorrow, and for your beneficiaries when you die. I want to talk to you about a couple of tax related issues that exist with qualified plans. So qualified plans are plans at work like 401ks, 403bs, TSP plans, 457 plans. These are all plans that allow you to pre-tax your money and not pay taxes on the growth of that money. Maybe there's an employer contribution they might be putting money in. And then, of course, you've got a couple of rules here. You've got the 59.5 rule, which restricts you from taking money out of these plans until the age of 59.5. Now, if you leave employment somewhere, you can take that money and roll it to something else. That's an IRA typically. In there, you can move that money wherever you want, but you've still got the 59.5 rule. Sometimes people leave employment at organizations and they leave their money there. Not a great strategy. So if you have what we call a stray 401k, you're going to want to talk to us about that because we've got better places to put that old 401k plan where you don't have to incur fees and have that money at risk. So you need to be mindful of the 59.5 rule. Also, if you're over the age of 59.5, you can do an age-based withdrawal where you can take some part or all of that money and get it to a safer place. Now, you've also got the 73 rule. It used to be 70.5, then it went to 72. Currently, it's age 73 where you have to take required minimum distributions. So for people nearing that or already in that phase, you're having to take money out of your qualified plan either at work, but if you're still working, you don't have to do that. But if you've left it in a 401k, you would have to take it out of there if you're no longer working. Or if it's an IRA, then you have to do it out of that plan at age 73 now. Now, you may not need that money. So what do you do with it? Well, are you going to reinvest it? Are you going to make more money so you can pay more taxes? That doesn't make a lot of sense, does it? So we have a place where you can put that money and never pay taxes again. And it's a pretty unique strategy that we use. We don't really get into it today, but we can talk to you about it in a future webinar event. So just make a note at the end or let Pat know that you're interested in our tax-free approach, and we'd love to get you on one of those webinars. So we've identified some retirement plan issues, have we not? Where Banks can be problematic in terms of their safety or return. We've got the stock market where you've got significant risk, you've got fees. It's not fair to have to pay the fees even when you lose money. So, what are you supposed to do with your money going forward? You've really got to have a different strategy, in my opinion, one that involves something that you're likely familiar with, and that is the ability to have money in a place where you've got absolute safety and then you've got some of the growth potential of the market. Moreover, you've got the ability to take that money in a pension stream. So pensions went away in the 80s and 90s and early 2000s to a large degree because companies couldn't afford to define the benefits that they were going to pay you at retirement age. That's what a pension did. So they were replaced by things like 401ks, 403bs, where the employer is defining just the contribution that they're going to pay you, and the rest is up to you. So you've got to kind of do this, right? That you're making the right choices, that you don't experience market drop, you don't live too long, inflation isn't a problem. What if you could remove all of that? Well, that's what we do. So with our products, you're never losing money, you're participating in market growth, and you're getting a product that has the ability to produce income for the rest of your lifetime, which is what most people want. Take the variables out of your retirement. The retirement problems today are the market dropping and you living too long. Most people are terrified of living too long, outliving their money. We're going to show you how, with us, that will never happen. So let's take a look at the green line, which is what we do. And I'm going to show you how our results would have stacked up in comparison to what the market would have produced in the S&P 500. So here on the green line, we're going back to our same point of origin, 1999. We're taking $100,000, and instead of investing it, we're putting it into a green line product. Now, that first year, you get some decent growth. You're up 7%, and that's pretty good. But when the market declines over the next 2 years, like it did during the dot-com bust, your green line account stays the same. So this is important. You're not losing. You're not participating in any growth because there isn't any growth, but more importantly, you're not losing what you earned. That's a real gain. You've locked that in. Now, when the market starts recovering again, like it did during the housing boom, you participate in those increases, each one of them. And you can see there that your account value is significantly higher than had you left all your money in the market. In fact, it's almost double what it would have been had you left it in the market. And if you're at a point there where you're retiring, well, that's making a major difference to you, knowing that your money is safe, it's guaranteed, it's protected, that you're not having to take 6 or 7 years climbing back up that hill like you were during the recessions of the dot-com bust or the housing bust. And then, of course, when the market starts responding over the last 10 or 12 years, you've participated in those gains as well. And when you assess those two different places to have money, the green line and the red line, they're about the same. So the S&P 500 would have yielded about 5.5%. So it's a little higher today. This was September of last year, that point there. It's a little bit higher today. And then the green line would have produced about 4.6%. People on the green line, I think you would agree, probably slept a little better though. And if you're nearing or at retirement, do you really want to worry about your money? I would think no. Now you'll see another line on this chart, and that's the blue line that kind of cuts through the middle there. What is that? Well, that's a 3% fixed account. So that's something that would have yielded just a flat 3% for you. And that beat the market 18 out of 23 years. That's a significant amount of time that a small 3% fixed account beat the stock market. So when you look at that chart, where would you rather have some of your money? Now, I say the word some because I'm not going to let you put all your money into a green line product. I think that's irresponsible. But your advisor wants all of your money. You shouldn't have all of your money at risk in the market. I think it's important to have a piece safe at this point in your life. Traditionally, advisors have used the rule of 100 to determine the piece that you should have safe. So you take the number 100, subtract your age, and that's the percentage of your money that should be safe. So if you're 60 years old, according to the rule of 100, which has been around for 70 plus years, you should have 60% of your money safe. It's just that Wall Street doesn't really have the tools for safety that we do. So now that you've seen the performance of the S&P 500 over the last 23 years, and you saw what happened in that period from 2000 to 2010, where the market was in negative 18%, if you're like most people, your question is, well, what if that happens again? So let's examine what we call the lost decade. So we started in 2000 with $100,000, and the first 3 years of the decade were, of course, negative. And that was followed by 5 positive years, some of them pretty dramatic. And then, of course, you had the Great Recession year of '08, where the market went down an average of 38%. And then it was closing the decade with 2 positive years. So the net loss for the decade was a negative 14,404. Now, on the right, you've got your money in the green line, where you're never experiencing those losses. So the first 3 years of negativity in the market did not affect your $100,000. But of course, you gained over the next 5 years. You did not experience a loss in '08, and you finished the decade with 2 positive years for a net gain there of nearly $30,000. So my question is this: what if it happened again? What if we had another lost decade? What if the next 10 years were negative? How would that affect you? Do you think that there's a possibility of another lost decade? So you're going to see a poll question pop up, and I want you to answer that in a yes or no for me. Do you think that we could have another lost decade? I'll give you a minute to answer that one. All right, thank you for doing that. So by now, you're likely wondering, well, what is the green line? What am I talking about here? What exactly is this product? So I'm going to tell you everything about it. The name of the product is a fixed index annuity. Fixed index annuity. So these are products that are sold by insurance companies. They're extraordinarily safe. They're different from the bad kind of annuities, which are variable annuities. So you might have heard of these products, that you might even own one, where they have a lot of risk, and certainly you can lose a lot of money, and you have to pay fees. The average fees in a variable annuity are 3.5% a year. This is why people think negatively about annuities. They think they're all like that. Well, they're not. Fixed index annuities could not be more different from variable annuities. One, they don't have fees, and they also give you several different ways to get your money out, which are a lot more attractive, in my opinion, than variable annuities. So they don't include any risk either. You're never at risk of losing money. You saw from our green line chart, you're never going backwards. Now, there are a couple catches, though, to these products, and these are catches that exist with variable annuities too. So you need to be aware of the fact that there's a time commitment. There's a surrender period, and that's as much as 10 years, anywhere from 5 to 10 years. Now, that does not mean you cannot take money out. Of course, you can take your money out. Every year, you have the ability to take a free withdrawal, and that amount is up to 10%. Now, what do retirement experts tell you today? Don't take more than 3 to 4% of your money for retirement, right? You've likely heard that. It used to be 5%, but then it back to 4% because of risk and your longevity. And then a lot of places now say 3 to 4% because of the increased market volatility and your longevity. So with me, you can take up to 5 or 6% of your money and you'll never run out. So we have a greater degree of liquidity because of that absolute safety on your money. You're never losing, you're never going backwards. So as long as you're okay with limiting to 10% out, one of these products may be good for you. The second catch to you is what we call the maximum gain. And this is the most interest that you can earn in any one year. So we know that if the market went down 20% like it did at the end of 2022, with me, you're going to get a zero. So that's the worst you'll ever see. If the market went up 10%, you can earn up to 10%. But if the market went up 15%, which is rare, kind of unusual, realistically, the most you might see in a green line product is 10 to 12% a year. You could do more. I've had clients in the high teens before, but it's kind of rare. And I want you to have fair expectations about what we're trying to accomplish, which is every year we're going to shoot for 5 to 10% a year. And then over time, we're going to settle on 4 to 7%. That's reasonable growth. That's what retirement experts will tell you is reasonable. And you're doing that with absolute safety on your money and you're not paying fees. That's pretty good. So, as long as you're okay with those two catches, time and gain, it might be good for you. I have another poll question for you, and that is what is the amount that you can take in a free withdrawal with a fixed index annuity? So, again, your poll question will pop up to the right or at the top. And answer that. What is the percentage you can take as a free withdrawal from your fixed index annuity? Answer that for me if you would. And the correct answer on that is 10%. You can always take a 10% free withdrawal. So I'd like to talk to you about some products today, if I could. And this will help you realize if this is something that you're interested in, what might be a good product for you to put your money into. So the first product that we're going to talk to you about today is a 5-year commitment. So under time, that's 5 years. The reasonable rate of return is 4 to 7%. Of course, there's no fees. You can take out 10% per year, and then this product does not have a bonus. The next one is slightly different. You've got a 7-year commitment, 4 to 7%, reasonable rate of return. You don't have any fees. You can take 10% free, and then this one does not have a bonus either. Now, those first two products that I've mentioned might be particularly good for someone younger or perhaps older. So I would say maybe younger than age 50 or older perhaps than age 75 might be a good fit for those. So these are products that give you reasonable growth and protection from market loss and doing it all with no fees. Now, sometimes people want their money to do a little bit more. And when I ask people at our public seminars, our dinner seminars, what do you want your money for, or how do you want it to grow? There's only really two answers. You either want that to grow for future income, or you want that to go to someone you love when you die. I don't think you want to leave that money to the bank or to your advisor or to the investment company. You want to either spend that money or you want it to go to someone when you die. And that's what the third product does exceptionally well. It's the number one selling product of all time. It's broken every record in my industry. And we have over 1,200 clients that own one. I own two personally. Pat and her husband own one. It's been the gold standard for many years now. Let's talk about it. So it's a 10-year commitment, 4 to 7% reasonable growth. You can always expect to never pay fees, and you can take 10% out every year if you need to. And then this one has a bonus, and it's currently 40%. That's the highest the bonus has ever been with this product. So when it was introduced 10 years ago, it had a 15% bonus. But you may have noticed that interest rates are up significantly today. 10 years ago, when this product was introduced, the 10-year treasury was a third of what it is today. So that translates to a much better product, and currently it's 40%. You would get that bonus as well for all new money you add for the first 18 months. So that you have the ability to save here, keep putting money in, and every time you do, you're going to get matched with 40%. It's kind of like that way that you were matched on your 401k when you were working. You're going to get a match by the insurance company with a 40% bonus. It's pretty significant. Now, this one gives you a second bonus too. So every year for the rest of your life, you get a 50% annual interest bonus. What do I mean by that? Well, let's assume that the average or your credited interest was 4%. they're going to give you a bonus of 2% of that, so a total of 6%. If you gain 6% growth, that's a bonus of 3%, yielding 9%. And lastly, if you get 2%, they're going to give you an additional 1%, so a total of 3. Of course, if you get a 0, that's going to be no growth all around. You can't multiply to a 0. And if you were to die, your beneficiaries have the ability to take that money over 5 years. They could do it over more years. And you'll likely note that on IRAs, if you pass away, your children have to take that money over no more than 10 years now. That was a change that came about with the Secure Act of 2020. So that product fits very well for people who are looking for a future income stream or to maximize what their loved ones might get at death. So I have a poll question for you. It's my last one. Is that an upgrade over what you have today? So if you like one of those products, answer that in a yes or no. Is that an upgrade over some account that you currently have? It could be a bank account. It could be an advisory account. It could be money in a CD, a stock bond mutual fund, maybe a variable annuity, or as well as any other annuity that you might have bought several years ago and thinking perhaps that it could be upgraded. Answer that for me if you would. Thank you. Now, a lot of times people have the same sort of questions regarding whether or not one of these products might be right for them. So I want to take a moment to answer some of those frequently asked questions. So one of the biggest ones is, what in the heck is my advisor going to say? Well, I want to be clear, your advisor is likely not going to agree with what I'm talking to you about because one, they may not be permitted to sell these products. It's very rare that a broker dealer will allow the sale of fixed index annuities because it requires a separate license and different training and a different level of compliance. And also, they probably want you to buy a variable annuity. That's all they're permitted to sell in many, many cases. So if you're looking to get your broker's approval, you're probably not going to get it. That's okay. We're not right for everyone. I always tell people we're going to be right for half the people out there, and I'm perfectly okay with that. But just understand that you could get some resistance from your broker. Every now and then, a broker does do what I do, an advisor, and maybe they've already done this for you. And let's hope that's the case. In that case, you've got a really good advisor, but it's kind of rare. The second thing that people want to know is what happens if you die? Can you take that money, or can your beneficiaries get that money right away? And the answer to that is, of course, yes. So upon death, they're immediately liquid, and that could be one day. So you bought this product, you died the next day, it's immediately liquid with no surrender charges. All of that money is going to go back to your loved ones. What about transferring money in? And most people transfer to us from a IRA or plan at work, like a 401k or 403b, 457. You can also use bank money, money in CDs, really any type of money. But do you pay taxes on that transfer? And the answer is no. So you're never going to pay taxes up front. You're going to grow tax deferred. And this is an important distinction with banks. Money in annuities grows tax deferred, whereas if it's in a non-IRA account at the bank, you're going to get taxed on that gain every year. That's not the case with our products. Annuities allow you to grow that money tax deferred. That's a big deal when it comes to accumulating money. But you don't pay taxes. You only pay taxes when you pull it out and spend it. At that point, you pay taxes on the IRA that you might have because you've never been taxed on that money. Or if it's a non-qualified account, you're paying taxes on any gains. But again, only when you pull it out and spend it as income. And then a lot of people want to know how I make money. Do I charge fees? And the answer is no. So when you're one of our clients, we do regular events on that third product because a lot of people buy that one. So we bring you in once a month, we buy you dinner, and we really take a deep dive in that and explain it even more than we did today about how it works. And we want to remind you how well that works. You never pay me fees. We do educational events for our clients, like things on wills and trusts, includes dinner. We do things on Social Security, includes dinner. We do fun events. We've done concerts in the past, trivia nights. We do all kinds of things for our clients. We give away pies at Thanksgiving. You never, ever pay me a penny for any of that. I really like being different. I strive to be different. I want to be different. I think there's a lot of problems in my industry with people not being treated the way they should be, with respect and courtesy, and being thanked enough for the privilege to work with you. And we always want you to understand what you did. So we strive to do that, but you never pay me fees. A lot of times people want to know what the minimums are with these products. So those first two products that we talked about tonight have a $10,000 minimum. That third product has a $20,000 minimum. Now, if you like what I'm talking about today and you want to set a time to come see me, you certainly can. And in my meeting, we're going to know within 15 minutes or so if we're a good fit. So you're going to have a lot to say about this. I'm going to ask you some questions. You're going to have questions of me, but in 15 minutes, we'll know if we're a good fit or not. And if we're not, that's okay. It's not the end of the world. And I'll tell you, this probably isn't right for you. But if you are a good fit, if you like what I'm talking to you about, then our meeting might last another 45 minutes or so. You see, it's really important for me to have with my clients the understanding that the most important thing that I'll ever do for you is create safety for some of your money. So that piece that you don't want to lose. Safety comes first with me. That's the one thing I can always absolutely promise you. You're guaranteed to never lose money. I like that. I sleep great at night knowing that. My clients sleep great knowing that they've got a piece that they can never lose. You've got to want reasonable growth over time. I'm not trying to beat the market here. If you're trying to beat the market, these products are not for you. But if you want to earn 4 to 7% over time, which is what our products have always done, then it could be a good thing for you. And then lastly, you've got to like the fact that I always keep things simple. So just like the webinar was today, we're always going to explain it to you in a way that you can understand, make a good decision, and make a decision that you feel comfortable with. That's really important. So I always want you to be comfortable with what you did, feel good about what you did. You've got to want those three things for us to be a good fit. So I would really prefer to see you in person. If you're interested in what I do, let's set up an in-person meeting. We can also set up a Zoom meeting. It's not as effective. I'll be quite frank with you. We don't always have the ability to get everything done in a Zoom call, but we certainly could do that for you. I discourage phone calls because that's just kicking the tires. Yeah, I've told you everything I do here. If you're interested in what I do, make the best use of your time and my time by scheduling an in-person meeting or secondarily a Zoom call. And let's get everything answered that I need and do my best to help you keep some of your money safe. Thank you very much for the privilege of your time today. I really appreciate your attending this webinar. I'm now going to turn it over to my assistant, Pat Marquette, who is going to go over a couple of things with you in terms of next steps for you. Thank you again.
Thank you, Mark. Thank you so much for sharing your knowledge and expertise with us today. I am going to show you how to activate your gift card. On the side of your screen or above, right next to that 3-bar icon, you'll see another one that looks like a gift box. It's where the offers are kept. If you click on that icon, you're going to be asked to take a short survey. At the end, you're going to hit submit. Once you hit submit, it allows your information to be sent to me, which allows me to have that follow-up conversation with you. So I look forward to speaking to each and every one of you. The gift card offer has been activated. So click that blue button, click to accept, and we'll talk soon. Thank you so much for joining us.